Why did the Indian rupee suddenly bounce back after hitting an all-time low? On Monday, the Indian rupee hit an all-time low of 87.95 against the US dollar, sending shockwaves through the market. But by midweek, the rupee had staged a dramatic recovery, gaining about 1.5%. So what happened? The Reserve Bank of India stepped in with aggressive intervention, selling about $5 billion through state-owned banks to stabilize the currency. This decisive action reversed the rupee's freefall and led to its strongest comeback in nearly 2 years. However, there's more to the story. The RBI's intervention has sparked concerns over India's forex reserves, which, although still healthy at around $631 billion, have decreased by over $70 billion since September 2024. But let's put that into perspective. India's reserves provide a robust 10-month import cover and meet key adequacy metrics set by the IMF and other global standards. Despite the rupee's recovery, the Indian stock market hasn't been as fortunate. Benchmark indices like the Sensex and Nifty have been on a losing streak, with over Rs 9 trillion in investor wealth erased. This sell-off is partly due to global tensions, including US tariff policies and Federal Reserve comments on inflation and interest rates. So, while the RBI's intervention has given the rupee a much-needed boost, the broader economic landscape remains complicated. Stay tuned for more updates on this financial roller coaster. Don't forget to like, comment, and subscribe for more business insights. The Indian rupee's recent performance has been a roller coaster ride, to say the least. The currency's sudden dip to an all-time low of 87.95 against the US dollar on Monday was a wake-up call for many. Investors and market analysts were left scrambling to understand the underlying causes of this dramatic fall. The initial reaction was one of panic as the market struggled to digest the implications of such a significant drop. However, the story took an unexpected turn by midweek. The rupee's remarkable recovery, gaining about 5%, left many wondering what had changed so quickly. The answer lies in the decisive actions taken by the Reserve Bank of India. The RBI's aggressive intervention involved selling approximately $5 billion through state-owned banks. This move was aimed at stabilizing the currency and restoring investor confidence. The impact was immediate and significant, reversing the rupee's freefall and marking its strongest comeback in nearly 2 years. But the RBI's intervention has not been without its consequences. Concerns have been raised about India's forex reserves, which, although still robust at around $631 billion, have seen a decrease of over $70 billion since September 2024. This decline has sparked debates about the sustainability of such interventions and the long-term health of India's economy. Despite these concerns, it's important to put things into perspective. India's forex reserves provide a solid 10-month import cover and meet key adequacy metrics set by the IMF and other global standards. This means that, for now, India is well positioned to handle external shocks and maintain economic stability. However, the broader economic landscape remains challenging. While the rupee has shown resilience, the Indian stock market has not fared as well. Benchmark indices like the Sensex and Nifty have been on a losing streak, with over Rs 9 trillion in investor wealth erased. This sell-off is partly due to global tensions, including US tariff policies and comments from the Federal Reserve on inflation and interest rates. These factors have created an environment of uncertainty, making it difficult for investors to navigate the market. In conclusion, the RBI's bold move has given the rupee a much-needed boost, but the road ahead is fraught with challenges. The broader economic landscape remains complicated, and it will take a concerted effort from policymakers, investors, and market participants to navigate these turbulent times. Stay tuned for more updates on this financial rollercoaster. Don't forget to like, comment, and subscribe for more business insights.